Let me introduce myself to you. Can you all see the slide which I have shared? Is it visible to everyone?
Yes,
Yes,
ma'am.
ma'am. Yes,
Ma'am.
ma'am.
Okay. Hello guys, I'm Sangeeta Verma and I've completed my MBA and recently only I completed my MPhil in management. In the slide you can see my work experiences. I've worked with advertising and marketing agency, bank, financial company, and I've worked as a HOD of a management in a college with export import company as an operational manager, and currently I'm working with a multinational international export import company which majorly deals with the Sri Lanka, Australia, India. Then some of the things are exported, some are imported, and along with that I'm working as a freelancer with LearnOvet. So today's session, guys, in the finance, we are going to understand and acquire the knowledge about risk, the different risks which we have to face when we are going with the financial market conditions, and even when we choose to study FRM, that is financial risk management, or we want to become a financial analyst in the future. So the topic for today's session is risk. Over here, we learn what is risk, different types of risk, how the what is liquidity risk, what is credit risk, and what are the factors that plays a role, and how we can lower down the risk factor by calculating, by pre-calculating and understanding different concepts, and how we can do the planning for it so that we do become a risk taker but thinking as a portfolio of risk averter. Risk is everywhere, guys. So we need to become a risk taker instead of every time averting the risk. So how we can minimize that risk, how we can pre-calculate it, and how we can analyze it. So let's begin. So when we go with the risk, okay, analyze. We all know that risk is everywhere, whether the risk is in our livelihood also. Let's take an example. When we play the games, there's a chances of becoming a winner or we losing it if our strategies are not proper, right? So, and even the risk is when we are learning to drive new vehicle, whether that is two-wheeler or four-wheeler. For instance, like if we risk of driving a car, if our speed is not proper, our foresight is not proper, if we don't know how to, at what time we have to give a brakes and accelerators and everything, we might lead to the zone of risk. So, exactly in the same way, in the finance, risk is like probability of financial loss, understanding what we can do. And then when we know in the business functions, when we know how to plan, organize, and control all the available resources to reach company's goal, along with managing that risk in a very systematic way in order to remain safe sided, whether that might be public interest, human safety, environmental factors, or other factors, whether that is the market, we are like all that comes with the concept of dealing with the risk. And when it comes to the financial risk, it is clearly said that when unexpected variability or volatility of returns, means actual returns on an investment will be differentiated than expected. Suppose we are doing an investment and we expected that loss will be only 2-3%, but actual loss in the lack of not able to manage everything properly, not pre-evaluating it properly and calculating it properly, it extended. So when these things happen, we have to understand that it is very important. Though we take a risk in financials, we have to understand the different four factors of different types of risk, basically market risk, credit risk, operational risk, and liquidity risk. Market risk is if we are not aware of what is the scenario going with the competitors, what are the prices that is going in the market related to whether it is related to bonds, debentures, shares, IPOs, FPOs, or the product itself, then there's a risk. And credit risk is when we took a risk of taking credit from anyone and we are again paying interest of interest, right? At that time, we should be able to understand that taking a credit risk is a disaster hazard for us. So we have to calculate it very properly. Then comes operational risk. Everything is set. Market, we know we have proper credit, but we don't know how to run it, how to operate it properly. And when we don't know how to operate, means whether it is business, legal matters, or you can say different aspects of the businesses and financial process, then we go with the risk. Means you have all the things, you have all the ingredients, but you don't know how to make it. It's the same like that. So it's very important that we know how to run our business properly. Then comes liquidity risk. It's like trading of a security or asset quickly in the market, and we are able to generate the liquidation form of that particular assets, building, or any shares, debentures which is holding up. So it is like dealing with the four types of risk in order to avert the risk and run our business in a very profitable manner. And then when it comes, no, like sometimes what happens that we might be expecting something and something else took place. Like take an example of we all know that Bill Gates is the largest stakeholder in Microsoft, right? We all are aware of it. But due to some reason, he was not able to analyze the liquidation risk and operational risk. What will happen? His business and Microsoft will collapse. So for him, he has hired many financial analysts to keep a keen eye on the shares which are going in the stockholders, right? And stock market along with the businesses going in the market and even with the competitors. So marginal inventors and investors, they both have to, every pillar has to combine properly to lower down the financial risk and stand on the profitable ratio. Means probability of having lesser risk or higher risk is dependent upon market calculation properly, credit calculations, operational runnings, and liquidation formation. So it's very crucial part of the finance, because at the end what will is going we are going to lose, we are going to lose our finance, the capital we are going to lose. So it's very important that we evaluate every aspect of the risk and try to make it to the zero is might not be possible, but we can do it to lower down it to 98%. 1% is always on a risk factor. Can I go to the next slide? Is this understandable till here? Now, when it comes to the types of risk in finance, what happens is there are two categories: systematic risk and unsystematic risk. Systematic risk are like uncontrollable by an organization, macro in nature. Unsystematic risk, that is controllable by an organization, micro in nature. So systematic risk is uncontrollable of whom? The investors or the company owners or the organization, like interest rate, market risk, fixed risk, absolute risk, reinvestment risk, directional risk, non-directional risks, basic risk, and volatility. These are out of control of business organization, a business person. But what is controllable? What is the operational risk? He or she has to able to understand and calculate it. Financial risk, credit risk, business risk, that is liquidity risk. Asset which can be converted easily in the liquidation forms, how much risky are that? Funding liquidity risk, then exposure rate, recovery rate, credit event, legal risk, people risk. Sometimes even people become a very traffic risk for the business organization, where they are not able to cooperate, collaborate, and understand the along with the understanding of mutual concepts. So that also comes under this one. Now, when we go to the graphical portion to understand the portfolio of whether that is of stocks, in order to understand diversified and undiversified risk, it is like a share market calculations of our this, because at the end what a big business houses are doing, they are arranging the finance, means the capital from different sources, and along with in that source share market is also a prominent one. So when it comes to the portfolio risk and number of stocks portfolio, you can see the graph. What happens? Systematic risk and unsystematic risk both have to be combined properly and evaluated, so that total stock risk can be calculated. And most of these undiversified market risk are lesser, because those are under the control of a business organization, and unsystematic, that is diversified, are not that good. Sometimes rate might fluctuate. You might be thinking that we don't need much reinvestment rate, but all of a sudden it bangs on. And if you are keen on share markets prominent, you can see every time the rates are changing mostly, and the one whose rates are keeps on fluctuating, people to generally do not go for such shares, bonds, and debentures. They like to remain on a static one, which is under the controllable one. So you can see the graph in that. Even when going to minimize the risk, financial risk pyramid also should be kept on a very keen eye, because this risk level of specific investment tools may change according to organization, according to industry. This keeps on changing as per business houses also. So what we can see is, like at the lower down of the pyramid, we can see in the pyramid, we should be aware to lower down the risk. We should be properly seeing that what are the saving bonds, do we have certificate of deposits, money market deposit account, saving account, checking accounts. Then comes bonds, how much bond we have issued or we have acquired, mutual funds and index funds. Then comes stocks and real estate. Upper value comes out commercial papers, options, and certificates, and then comes the futures. We go generally with the five pyramids crossing, and then we reach to the our extensions one, means speculative investment tool. So you can see in the picture clearly, increasing potential for higher returns increases risk. When we want to get higher zone of profit, the chances are equal. It's not vice versa, okay? It's equal. If we expect some profitable ratio as 80%, there's a greater chances of loss also if our risk is not evaluated and analyzed properly. Till here, any confusion, guys?
No, ma'am.
Okay. Okay, let's the see the risk model, how the risk model plays for a business organization to deal with. And this is a very realistic one which we follow in our workplace. Simple risk model. Let's see first simple risk model. What we do is we whenever we go through any new deals or new promises, new product launching, what we do is we evaluate the risk of that product or risk of that deal cracking out. So probability of risk, event, and impact, that is indicated as P0 from our side. And then drivers means what they are leading of, whether uh, a series leaded or bond we are leading, or we are dealing with it with the uh, fluctuations of interest rate or reinvestment rate. What is the drivers reading out? And then risk, event, and impact, we just go with the one phase, two things we see, and then we evaluate the risk, and then what will be the total loss. A good businessman does not think of profit first, he thinks of the loss first. When we do any business, we see that how much we are going to lose, because when you know that what is your loss ratio, you always try to minimize it, and automatically your profit enhances. Than total loss. If you go with the standard risk model, they go with the two in probability of impact. One, probability of risk event itself, and then impact. In a simple one, they see both combined form, but in a standard one, the impact is probability is calculated, then event probability risk is calculated. Drivers are also impact drivers and risk event drivers. They both get evaluated, risk event and impact is seen. Then we reach to the what is going to be the total loss of our organization. So the two models, it depends on organization, it depends on product, it depends on different financial standard out market or market competitions. The organization, the industry, or the businessman can decide which one model to follow. So when we see that how it is done, we can see here is like historical data. When we go, suppose we are thinking to invest our being an investor, we try to invest in Tata Group. Let's see, we see what is the historical data of shares and bonds and investment and finances ratio in that historical one. Then we seek some expert opinions whether it is good or not. Then expert opinion doesn't mean that random ones, okay, those who are dealing with the actual financial market, actual scenario of the companies and organization. Then input probability contribution is seen. So you can over there what you can find out is you can find out the deterministic ones. What is that? The formula is dy by dx minus 2xy equals to x squared minus x. Over here we calculate it what historical data and expert opinions, and then we input from our side some of the points, and then that is calculated. So Monte Carlo simulation model is also followed, output probability distribution is also followed. And when these steps are followed properly, then we see what was our expectation, how variable this thing was, whether we are lowering down the stress or increasing the stress, and scenario analysis. If I do this thing, if I right now I'm investing 20 lakhs in this business, whether this business is profitable or not, for that it's I hope this business will not go in a loss. That loss is calculated first and then analyzed, and then only the investment is done. So better business decisions always revolves in the proper analysis of company, proper analysis of business form, proper analysis of product. And if you are thinking of getting totally in financial market only, proper analysis of every share bond, debenture, and the financial share markets fluctuations, interest rate, reinvestment rate, liquidity rate, credit risk, everything has been evaluated, and then only a person thinks of doing out the business in the scenario. Suppose some of you might turn out to be a financial analyst, and then you need to have a very keen evaluation every time. It should be for you is then not a single fluctuations of degree interest rate gets disappeared from your vision. Every time your vision should be on that, and most of, if you will see then keenly, if you invest, then if you invest 3 to 4 hours of your time in financial markets or sales markets, you become good. If you do not have time to properly focus in it, you cannot be a financial analyst, because most of us investments, finances, clients are dependent on your verdicts. So this is very important that you evaluate it, whether you follow the model of simple or standard for your business organization. Till here, any confusion, guys? Okay, let's
No,
see the
ma'am.
next thing. Liquidity risk model and credit risk model mostly are evaluated in a business organization in order to understand how we can lower down the risk, how we can avert the risk, and we can move on ahead. So, liquidity risk model, what we see in that, we mostly see the profile, liquidity profile, that is how we can bring out the cash flow if we are running in a shortage of it, whether the instant liquidation scenario is there or not. Then we see the portfolios like fixed income interest and equity funding. And then comes investment class, whether that is with the bonds, equities, treasury bills, commercial papers, shares, debentures, mutual funds, what class of investment we have done, being an organization or being a business person. Then portfolio, like suppose you took a share of any company, you have 1000 shares, and in a monthly basis you are get earning, um, take 20,000 from that ones, right? Until and unless maturity period is not over, you are getting an interest of fixed interest. So that is your fixed income fund. Equity fund like 30 days, then 100 days, 250 days way of earning the funds. And then liquidity like your assets, your commercial papers, your ancestors properties or anything, or the funds which you have allocated or your savings, all that comes in the, whether that can be liquidated properly on a time or not, that is being seen. And then when all this liquidity profile, portfolio, and then investment class, when this is seen, how much percentage you give to them in order to avert the risk and run out to the business, it depends upon the calculations which your experts, your financial analysts have done for you, and even you have done by yourself. Like cash is 25%, and if I have to arrange it in a fixed cash, 2%. So it depends on the liquid investment is 100% liquidity risk or not. That has been calculated, and then risking out how much we can risk, whether we can only risk 20% of our liquidations or 30%, that has to be evaluated. And then comes credit risk model. Over here, it's totally on a interest, and interest, it's like cycle interest also. So a person who is giving you a credit, or a bank which is giving you a credit, or an organization who is giving a credit, or sometimes financials or investors are giving you credit, it is calculated whether they are charging interest in a very nominal one, or you have already dealt with them and fixed it, or the market scenario. If a market rate increases, their rate increases. If market synchronized, they're also synchronized, either wordings, or you have fixed proper interest in order to give to them. And sometimes even they charge interest per interest, means running interest. Suppose this give, like you can see example of credit card. We take a credit from them, and in 20 days, if you till 20 days your interest rate is 5%. If you are not able to pay that, what happens? You get an additional amount of interest. Like today it was 5%, and in that 5% is already there. In that also 5% is added. So in that way, whether your model is running in a way of credit risk or not, that has to be evaluated. So basically, operating risk is totally dependent on how you hire, how much knowledge you acquire about the business, market, competitors, and how you're going to run it. So operational is over there. Market, you have to have a keen knowledge, that is your market analyst person, or you being a market analyst has to have a proper analysis, proper objectivizing, and understanding this scenario. So that depends with the credit risk model. Till here, any confusion, guys? Okay, let's go to the next slide. So first, let's see what are the factors that affects the stock prices. Sometimes economic and sometimes corporate itself. So economic, what comes? Inflation, recession, interest rate, consumer spending, and employment. Factors affecting stock prices. If you see in a corporate wise, the business is not profitable. So if that is there, it's affecting. So you have to be very sure that profitability, then sound business management, growth potential, size of debt, dividend yield, price earning ratio. So these plays a role of corporate affecting the stock prices, and inflation, recession, interest rate, consumer spending, and employment. We all know that since it's a time of COVID out running out, we might have seen the economic and corporate both has been hit very hardly. People are losing out their jobs, spending of a consumer is decreasing, some of them are not able to pay the interest rate and they are like in a very deep grief. Then inflation is there, recession is there. We the thing which we used to prior to COVID, we used to give 40 rupees, now we have to give for that 100 rupees. Inflation of 60 rupees is over there. And then if you see the profitability, business peoples are debting, taking credits, being under the debt, and they're not able to calculate their price earnings properly and running the business for 6 to 7 months and shutting down. So in but positive side is many smart people with the financial market also come up with the startup plans and they are doing great. So why they are doing great? Because they first analyzed the risk, the losses, and then they are dealing with it. So their analysis, observance, and eradicating four risks from their business has been done very properly. Then factors affecting real estate markets, same thing, okay, is gender, income, migration patterns, economies, and demographic. So real estates are also been like that. Now if we go with the model, how we can understand and what are the patterns of risk which we can lower down, how it is. So first we have to identify what are the factors of risk which are causing our business in a loss. Then we have to categorize it, because sometimes quantitative and qualitative also matters, whether diversified or undiversified, whether higher interest rate, lower interest rate, less amusing and higher amusing, that plays a role. Then comes risk mitigation, like sometimes business organizations, people's behaviors, actions, they are not able to hit it hard during the time of tracking the deals. So risk has to be acceptance by them, and they have to rework on that. Then comes risk management. Risk management is like continuously monitoring on the risk. Not a single pattern is missed out, and the actions to control them. You can see, so you might have gone through the G Business news channel. You might can see the many people comes over there and they talk about shares and debenture, how you can deal, how you can see what are the actions which you have to take and play. So that is totally on the risk ones. And then proper planning of financials. If you want to put your finance on a lower risk, planning process should be very proper. That is understanding and identifying your needs and objectives. What do you want from your business? How you're going to invest your funds? How you're going to arrange the fund? Who are the different peoples which you're going to hire? So all that proper way of gathering information, analyzing, planning properly, then implementing the plan, and again keeping an eye on those plans and implementation plays a vital role to decrease the risk. Now, if you see in the markets over in this one, please say stay focused and understand the concept. Measure of market focus. Market have pros and cons, and if you are not able to understand that one, you might be on a tough troubles one. So there is no single measure of risk that can provide consistent view of risk across market participants and regulators. Like you can see dollars prices increasing, decreasing plays a vital role on the commodity market, right? Shares hardly does not play, but commodity market can be seen that so much of pros and cons. So value of risk, that is VAR, should be properly understood. Proper regulator, proper reporting has to be done, whether that is simple or not, where lacking of coherence is going on. We have to understand that. Then expectation shortfalls, and then stimulations is very important. So when we generate it with proper way, so market risk is risk of change on decrease in value of investment due to change in uncontrollable market factors. It is also known as systematic risk. Market risk, which has a change on decrease in value of investments due to change in uncontrollable market factors, that is interest, equity, currency, commodity, margin, and country. So these are comes under systematic ones. So these are like beyond the control of individual or organization. Interest rate are not on your hand. Equity risk is not in currency. As I said, dollars prices keeps on fluctuating. Commodity risk, commodity in a commodity risk, the best example is silver, gold, platinums, and all that. Then comes margining risk, overcoming the positions, and country risk. Use like sometimes governmental issues, sometimes unrealistic, unwanted political issues, geographical issues, demographic issues, then inability, not no stability during the peace, then comes deficient ones. All these plays a role. And what are the measures? Measures is knowing the proper value of risk, method, and beta coefficient. Then when it comes market risk, obviously market risk premium also comes with it. So the additional return on investor increase for holding a market risky market portfolio instead of risk free asset is termed as a market risk premium, like required market risk premium, historical market risk premium, and expected risk premium. And even in this you can see the value, that is formula how to calculate market risk premium. You expected the return from some of yours, that is your rate of return expectation was higher, and but risk free rate was low. So you need to calculate it using the formula. risk-free premium is mostly calculated with the assets or investment return, and then a return on the free return, that is risk-free return. So risk premium is calculated the assets or investment return which you expected minus risk-free return, which has been decided by the market or by the credit series or by the competitors way or in the financial share markets. And there are vast, its topic is vast and the formula is also vast. Now it comes risk exposure. Risk exposure calculates the effective current cost of a risk and can be used to prioritize risk that requires countermeasures. So the formula for this one is probability of risk occurring or assuming into total loss if risk occurs. Probability of risk occurring. What is risks? We assumed I as a 60%, but it was like high fight. Over here you can see in a table, I've tried to explain it, like risk take product recall stimulation, significant product rejections, and competitive strike. We thought that in product recall situation there might be the assumption of, we can say 2%, and product rejection we thought at 0.1 people are not going to reject our product. Competitive strike came to be 10%. Then total loss, if it occurs, is 80. We can do that. Probability of assuming is in percentage, but when it comes with the total loss, what can occur always comes with the currency value. That is 80k, 1000k, 25k. So risk exposure, how it was calculated. We said was RE equals to probability of risk assumed. In the first one, we assumed 2% risk, right? What was the total loss? 80k. So 2% of 80k came out to be 1600. When it comes with the significant product rejection, how we can calculate? We can do 0.1% into 1000k, the answer will come up. And then if it is competitive strike, 10% of 25k is 2500. So higher risk exposure indicates most serious risk. So when we calculate, we should see which coherence is coming higher. So in that way, we can calculate that the risk exposure to particular link is higher. And we should always try to understand the risks factors. So when we calculate relative risk calculation is how, like relative risk calculation is always with the, you can see with the table I have tried to make you clear, like a slash a plus b, c whole slash by c slash c plus d. Like over here I have given 354 to the a and 143 to b. Exposures 1. So when it is calculated, it comes 2.54. In the same slide, you can see different formulas to calculate the risk, like average risk, consequence of risk, then probability of risk impact, perceived risk, average risk variance, disability. So these formulas should be very properly learned out, and you should be able to use it in a very proper way, because that we'll see in the practical session. Now when it comes to the Excel, you all know that these days it's like we all have become techno savvy. So instead of manually calculations with the use of calculator, we use Excel sheets to do it. You can see likelihood interest in this. So we highlight it with the different colors. It is dependent upon you whether you give red, blue, green, yellow, purple, whatever color. So you can organize it in that way. When it comes to the real premium calculations, the formula is 1 plus nominal rate slash 1 plus inflation rate minus 1. So when it is Excel sheet is used, you calculate it in a very fast way, right? So larger company stock investment is 12%, US Treasury bill is 4.80%, inflation is 2.10. You just what you do, you calculate the calculation, that is real premium with just the use of formula. And the premium which is also calculated as market risk premium, that is expected rate of return minus risk free rate, which we have discussed earlier also. So with the help of technology, with the help of softwares, the calculations have become very easy. We just need to focus and we just need to understand it. Now when is risk free rate of return formula, it's already discussed, but still I will try to make you understand that it's very important. We know that inflation rate is how much, and if inflation rate is 5%, it's 5%. If it is 10%, it changes out, right? So government bond rate also changes out in that. And these all we will see in the practicals one. Let's understand the formulas first. Then comes with the help of Excel sheet these days, or SAP software, ERP software, different softwares. Relative risk reductions is also able, like we try to control the event rate and experimental event rate. So in this one we can understand that it's very important that control event rate and that experimental event rate divided by control event rate. One rate is expected, one rate is actual, and even the market rates are also calculations. Even to calculate systematic risk and unsystematic risk along with the total risk is also acquires a formula, that is beta coefficient, C list, B variance into variance of market index. And unsystematic ones is total variance minus systematic risk, that is total variance is X coefficient A minus systematic risk. Systematic risk formula is beta coefficient into variance of market index. When those two are added, obviously the total risk will come up. Now, value at risk, if you see in the monetary ones, how it is calculated. Certain values are given to you: volatility, correlation matrix, covariance matrix, and weightage. These are required, and the formula is beta square P by weightage infinity W's. So all the values are used properly, and then the value at risk is calculated. Over here in the same slide, you can see a panel, Excel panel, where it is what it is done is, let me enlarge for you. In this, all the variance of the risk are been calculated and evaluated with the help of interactive software, which helps you to understand the graph way and the calculation way in order to minimize the risk scenarios. Till here, any confusion, guys?
No, ma'am.
So this is an actually going in the share market. If you see these graphs, these charts keeps on fluctuating, going up, reads are made, and even when you do what you do, you keep a financial analyst, or you yourself be a financial analyst for your business organization. You keep a keen eye on, and you, with the help of market evaluations, liquidity evaluation, credit evaluation, operational evaluation, you try to see the steps and the current where the risk can be lower down, losses can be lower down, and the profitable can be given. So you basically understand the mass market risks, risk drivers, and liquidity and funding risk, how you can minimize them, and to in order to successfully establish out your business. So when you go with the different variance portfolio, you reach to the final portfolio where you see the ratio of risk is lower. So sometimes people might ask you, why is the marginal inventor assumed to be diversified? It is very important because once it is like exposure as an investor, if you are exposed to risk, in order to clear the both scenarios, what happens? The return from the risk is lower down, and your expected risk might be much more lower down. So different models are also like followed, no, in order to calculate the risk, that is CAPM, then portfolio calculations, market evaluations, and sometimes it might be that an investor might get negative beta. Okay, it's all the scenarios of variance, value of money, value of return, beta, coefficient, correlations, all this. Like sometimes it is risky out there that investment people get a negative beta. At that time it is very important that restrictively or unrestrictively you do not try to take a risk in that particular market. And different multi-factor models are also like used in order to lower down the market risk, because lower your exposure to the market risk, it becomes difficult for you. So every pros and cons of market risk should be in your determinants in order to eradicate the things. Basically to understand is like earning per shares values, earning per equity, that funds from operations, capital expenditures, how you are mobilizing your working capital, all that has to be in a very bond rating scenarios. So when you do the ratings process properly, your financial risk is lower down. Till here, any confusion, guys? Thank you for the attention. Any queries? If you have not any queries, I have a question for you people. You guys do not have. Okay. Suppose if the risk less rate increases, will the slope decline or incline? No response. Am I clear to everyone and audible to everyone?
Yes,
Yes,
ma'am.
ma'am.
Okay. So we'll in the next session we'll calculate some of the practical sessions. For today, thank you so much patiently listening and attending the sessions. Thank you so much. The slides, the presentation will be shared to the organizers, and you, if you have any queries, you can contact to them. And for a time being, let me share a funding ratio video with all of you.